And welcome to Overtime. I'm Mike Santoli in today for Scott Wapner. Let's get right to our talk of the tape. Buy the dip is back. That's the market call from Virtus Investments' Joe Terranova. He says any pullback could present a big upside opportunity. And Joe is with me here at Post 9 to talk more about it. Joe, good to see you. I know you weren't talking about just an intraday buy the dip, but we got one, and we also got to sell the rally. Let's break down today just a little bit and where it sort of fits into the context of what we've been seeing, this sort of chase up to the highs of the day. We're up about 0.5% on the S&P before it kind of hit a bit of a wall and pulled back.
I think it's been remarkable, the journey that we've gone on here from a technical perspective, how perfectly it's worked. Think about early July, we finally nudged above the 50-day moving average. There was skepticism, it's going to fail. No, it raced right towards the 100-day moving average. So we're erasing a lot of the skepticism. We are certainly rebuilding positions in the growth strategy that were carried at a significant underweight, arguably the biggest underweight since the great financial crisis. And now, perfectly, the S&P 500 tests the 200-day moving average at 43.26. We had Jonathan Krinsky on yesterday on halftime. He mentioned the first time that the S&P challenges the 200-day moving average. When it's sloping down, it tends to fail. Well, Mike, that's exactly what happened. We bumped our head against the ceiling, and we fell right back down. 43.25. 28 was the high, right? So it's basically within a point of that 200-day. But does it tell you anything that it has mostly been the people who pay most attention to the technical mechanics of the market, and what that tends to signal going forward are the ones that are most willing to buy into the idea that a low is in, whereas people who are waiting for the macro to look more friendly, or waiting for the Fed to send some signal, or waiting for the economy to reaccelerate, are a little more hesitant to do so. So you've been doing this just as long as me. And generally, when you react and don't think in the market, you're more successful when you take away the emotion in your decision process. So a lot of the buying is coming right now from non-discretionary funds that are following technicals.
Yeah.
They're rules-based, so they're not thinking through, well, is inflation going to have another step back higher? Is the Federal Reserve going to have to be a little aggressive? How deep is the recession? They're just basically following along with what the market is dictating, and they're entering the market accordingly. So I think, look, at the very least, if we stall here, okay, this was a market for the first half of the year that was all about sell the rips. I think we've reversed that now. I think now we go back to buy the dips.
What does the latest run of economic numbers, the earnings from the big retailers, the decline in oil prices, frankly, how does that all fit together in terms of figuring out what the fundamental story is going to be that people will be latching onto, and therefore kind of then deciding whether the market's gone too far or not?
So first, let's address, because you and I talked about this before the show, the price of oil. Everyone's talking about the 200-day moving average for the S&P. How about the 200-day moving average for the spot price of oil? This is the 10th consecutive close below that moving average, which sits at 95. In fact, in the last two weeks, we tested $95 twice. Again, bumped our head against the 200-day, fell right back down again. So that certainly is a positive for the consumer. But I just think overall, it's clear the price to pay for combating inflation is an economic contraction. Okay, well, how deep is the economic contraction? And a lot of the evidence that we're getting suggests, well, that economic contraction is actually going to be shallow in its nature, which is obviously a good thing for consumers. But we have to have an economic contraction. You have to take the slack out of the economy.
I was saying it earlier that the reason that the decline in oil and gasoline seems like it almost has a multiplier effect in terms of market psychology is that it seems so intricately linked with what the Federal Reserve feels it's going to have to do. Is that a safe way to think about things? In other words, the Fed officials, Jay Powell, saying gasoline prices feed headline inflation feeds consumer inflation expectations. Those things are the problem. We need them to get down. And now we have gasoline rolling over and oil, as you say. So is it as easy as that?
No. And it's certainly not safe. And if you could look at the price of oil and be satisfied that we've combated inflation, no, that's the wrong way. I think the thesis has to fall back on the consumer is resilient. Corporations are resilient. Corporations clearly in the last quarter, they lowered guidance significantly. In fact, it was the first quarter since April of 2020 in which S&P companies actually lowered guidance more than they actually raised the guidance. So lower expectation, it has to come from corporate and consumer balance sheet strength. That's the optimism, not because you believe that the price of oil means that the Federal Reserve is going to pivot.